history is going to show this will be the worst real estate crash globally in all of history. This will be only one of maybe 3 or 4 such major 80, 90% crashes in stock. This will be the only real estate crash. So I'm most worried because almost everybody owns real estate. Only 10 to 20% of people own 80, 90% of the stock. So this real estate thing is what's really going to hit.
Hello, everyone, and welcome to another edition of Triangle Investor Interviews. I'm your host, Lucian Valkovic, and before I announce my guest, just a quick reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy or sell any shares, products, or services. Always do your due diligence. And my guest today is Harry Dent, an American financial newsletter writer, demographic researcher, and self-styled contrarian economist. Mr. Dent, welcome to the show. It is your first time here. It is great to have you.
Yeah, good to be here, Lucy. And I was speaking at a conference not too long ago, and they introduced me as the contrarian's contrarian. And I'm like, oh my God.
Yeah, perfect. Harry, we have a lot of things to discuss since, like I said, you're for the first time in my show. Let's start maybe on the imminent crash timeline, I would call it. In your forecast, you describe a front-loaded crash hitting markets in 2026, 2028, period potentially worse than 2008. So my first question is, let's say with Q3 2025 GDP beating expectations at 3.5, what specific demographic signals like millennial spending slowdowns are you watching right now that could trigger this downturn as early as as soon as possible?
Well, you know, this economy has become so artificial since 2008 when it's been $29 trillion in the U.S. alone in stimulus since then, which is enough to have grown GDP 8%. And we've only been growing adjusted for inflation 2.5%. So the whole thing, there are no normal indicators. What I really look at this point, listen, I'm looking at the leading sectors and stocks, okay? And the two emerging sectors, and bubbles always come. I mean, the first bubble was not from 2002 to 2007. That was a normal peak demographic boom, okay? The last bubble was from 95 to early 2000. That was the first tech bubble with the rise of the internet in the mainstream rapidly. Now, this one is coming later. This is the second tech bubble, and it's about the rise of crypto technology, which is about the decentralization and restructuring of all financial assets and money. That's huge. 630 trillion assets in the world globally. And now, secondly, it's about Nvidia, which is called AI. In my biggest selling book, The Roaring 2000s, back in 1998, I called this the automation of managerial and professional work. We're always automating jobs, okay? It was farmers way back, and then it was factory workers. And then it's in recent decades, it's been clerical workers. And now it's going into professional and managerial. That's the last row. And it's the most potent people to automate. And then people always say, well, we're going to lose all our jobs. That's the last thing, Lucy and I worry about ever in economics. We always create better, more creative, higher skill jobs by automating older ones. And so there's nothing wrong with this. And we're just beginning this, and it's a great thing. So I'm not worried about that, but I am worried about the stimulus that's put in the economy to react to the natural demographic downturn from 2008 to 22, which I forecast in all of my books way back in the 1980s forward. That the baby boom would drive us up from 83 to 2007, and then we'd have a downturn from 2008 to 2022, 23. What they did was all government, but U.S. alone, 29 trillion, again, 7.6% of GDP on average for 60 years. That's how much they countered this downturn with, which to me is reckless. And to me, it's just going to cause everybody to overspend now. And then and get more and more debt than any boom. And every boom has rising debts, and all those debts are cleared out in the next downturn and correction. So they put off the last downturn after the baby boom peak in 2007 and the crash in 2007 and 9 should have happened 2020 to 22. Now I think it's going to happen from late 2025 into 28. And these type of major debt detox, as I call them, and corrections typically take 2.5 to 3 years. 29 to 32 was 2.7 years from top to bottom. And then the economy bottomed about 6 to 7 months after the stock market. That's the natural cycle. So the only question I have, since this should have happened 6 years ago, let's say, when does it start? And
Yeah.
I think this is the perfect time. I mean, we've got, and I'm looking at the two leading stocks in or two securities in the two leading sectors, Bitcoin and crypto, and Nvidia and AI. Bitcoin looks like to me it just peaked on October 6th and it's gone down 17% and has bounced back to support and is coming back down again. If Bitcoin continues down, stocks should follow and soon and put in a peak, which they're right near a top now, I think. Nvidia is coming last. And I think I just told my newsletter subscribers Nvidia looks like a last blow off top that could have peaked literally around 2011, 12, just yesterday or something on the 29th or soon. So I'm looking if Nvidia starts heading down rapidly like Bitcoin already has, that will seal the deal to me and say we've likely seen not just a normal top, but the top of the biggest and only 100% artificial and longest 16-year bubble in
Yeah.
all of history. So the downturn is going to be strong, and I don't think they'll be fast enough to counter it at this point. They've blown all their ammunition now with 16 years of stimulus at 29 trillion. How can they now say, oh, after 29 trillion, it's going to take another 30, 40 to get us through the next round? And at some point, the markets and people will say, I'm sorry, we've seen this play before.
Yeah, let's say you are right about all you said over here. What kind of correction can we expect, or we can really expect a meltdown, a real
Yeah,
meltdown?
yeah,
What's
a
your take?
real meltdown. Now, I'll tell you, the thing I started, I researched way back when I realized we were in, but not just, I was, all my books were Great Boom Ahead, Roaring 2000, the economy's gonna be way better than anybody thinks. When I realized it was more than that, it was bubbly like the Roaring 20s. I started studying that and the accumulation of debt and all this sort of stuff and all. And what I found is when you have a bubble like this burst, and I looked at all 10 bubbles throughout all of this modern history. The key is the first crash. The first crash averages 42% in 2.3 months. So yeah, the whole crash is going to be 80 to 90. In other words, bubbles don't crash 50% like we saw in the 70s from a normal boom, okay, generational demographic boom. And then the 73, 74, that was the big crash back then. It was 50%, okay? Bubble crashes tend to be 80 to 95%. 29 to 32 was 89%. Okay. And the first crash hits the hardest when people least expect it. And the 29 to 32 crash, the first wave down was 49% in the Dow in 2.5 months. So when people say, well, Harry, I'll wait. And then if you're right, okay, if you wait, it'll be down so fast, more than half the whole crash will be happen before you react. Then you'll probably likely sell at that bottom, and there'll be a big bounce to say, "Oh, you were wrong," and then people get back in, and then it keeps going down. The
Yeah,
next wave will be as big as the first wave. I've looked at these crashes. So the first crash is the highest percent and the fastest. The next crash is at least as big, but a lower percent because it's coming from lower level. On and on sort of thing. But it's people have not seen this. The 2000 to 2002 is the better model, and that was 78% in 2.5 years
yeah,
on the NASDAQ. So I think my targets are 90% on the S&P 500 for a bottom. I'm going back to the 2009 bottom in stocks, 90% for the S&P, 95% for the NASDAQ or the QQQs. And for real estate, which did not bottom and doesn't go down as much, but did not bottom until 2012 in the US, we have to go back to there, and that is 60 to 65% of which we've never seen in history. The last one in the US, the first real estate crash, 2006 to 12, was 34%. And that was devastating because people have 80, 70, 80, 90% mortgages against that. So people are actually don't just lose 20%, 30, they're underwater and they lose everything in some cases. So real estate, if it goes back down to just the 2012 lows, which is to me the only viable target from something's bubbled this much, my gosh, it's going to be 65%. And if you're in a really upscale house or in a really super bubbly area, it could be more than that. That is going to be the worst. History's going to show this will be the worst real estate crash globally in all of history. This will be only one of maybe 3 or 4 such major 80, 90% crashes in stock. This will be the only real estate crash. So I'm most worried because almost everybody owns real estate. Only 20% of 10 to 20% of people own 80, 90% of the stock. So this real estate thing is what's really going to hit people.
Yeah, my next question was about housing market, and I saw one of your interviews where you called 2025 the sale of a lifetime for housing due to a massive correction. But what's your advice what should first-time buyers, how should first-time buyers position themselves?
Well, again, a first-time buyer should just wait. I mean, first-time buyers all have the same complaint. They're the ones suffering the high prices from all this bubble. The baby boomers bought a long time ago, but if they've been prevented from buying a house because of high prices, they ought to bow down and thank God, okay, over this, and they should wait. You wait until you see this bubble start to crash, and the more it happens, wait more, because real estate last time took 3 years to have the stocks only went down, took 1.7 years to hit their bottom, 2008 to 9. Real estate took 3 years to have most of the crash and 6 years to bottom. So real estate, you have to wait longer and give it more time. And you also have to get out earlier, like now, because if I was in stocks, I could say, okay, I might be willing to let the first crash show itself, the first whack, maybe 20%, and then sell on the first bounce. Real estate clams up to it. Real estate gets hard to sell quick. So I tell people, your real estate is where you're the most vulnerable and where you'll be penalized the most, especially if you have high mortgages. And I also, one of the questions I get at every presentation, Lucien, is a lot of people have 2 houses, their vacation home and their main home or something like that. And they always think, oh yeah, I've got my main home's paid for. I should keep that one, right? I should sell the one that's got the big mortgage. I say, no, the bank owns that home.
Yes,
You
exactly.
sell the one that's got all the equity in it. Give yourself massive amounts of cash to take advantage of the sale of a lifetime in real estate, which nobody will see for decades in either direction. Okay. You sell the one with the equity. I'd say sell them both. But if you're going to keep one, I'd move into my vacation home for this crash and I'd sell my main home that's paid off or has a very low mortgage, because that's where you're going to save the most money and be able to and create a huge amount of money to buy when real estate's at price. The problem with most people, between their assets going down, including their real estate and stocks and everything, and banks tightening up, the worst in history, they won't be able to buy the sale of a lifetime. They won't be able to get a loan, or they won't have any money to take advantage of it. So
Yeah.
sell your high equity real estate now and sell your stocks and financial assets, and you will have a horde of money to buy at the best time in history. No, people will be talking about the buy opportunity of a lifetime. This will be like buying stocks in late 32 and housing in 1933. I mean, you would have never seen those prices ever again.
So the times of cash is king are returning big way.
Yes, I tell you, but there's a better. Cash is great. What is much better is and this was even more true in the 30s and definitely true in 2007 to 8. The only thing that went down and up When the crash really set in 2008, it was not gold. Gold only went down about 40% and for a short period of time, but it still went down, okay? Treasury bonds went up 40 to 50%. The safest investment in the world, a 10 or 30-year Treasury bond, and the 30-year are the best. They went up while everything else, again, even including gold in the end, gold would have been the second place better, but you still lost maybe 40%. It's the only thing that went up. And then when those go up, and they will spike mostly at the worst of the crisis, most of those gains were in the second half of 2008. When you see them spike like that, then you sell those and get ready to buy stocks and real estate again, because those are what are going to lead out here. You don't want to hold these treasury bonds forever, because we've been in a low inflation environment, which my indicators told also. We didn't just predict the great boom. We said inflation is going to be near zero in the 90s and 2000s, because inflation's not caused by government deficits. That's minor. It's caused by young people entering the workforce. From birth to entering the workforce is a huge expense with no return. My one sentence is, kids cost everything and produce nothing. Okay, which is,
Oh,
and
yeah.
people get that right away. Not nothing, but very little until they enter
Yeah.
the workforce. And they enter the workforce on average at age 20. Another predictable thing. High school 18, college 22. You average those two out, and the statistics say the average person enters the workforce at 20, will spend the most and be the most productive into 46. Higher income, higher educated people will enter later and be productive into their early 50s before they plane out. I mean, the rest of the curve, it's all predictable. And economists act like nobody can predict the economy past the next election. Nothing's more predictable than the spending of mass numbers of people on average. Averages make the economy predictable.
Yeah, you have a pretty different view on gold, and I really respect that. Unlike people are, the 99% of the people are gold bucks. So
Yeah.
you have to,
Especially, yeah, they say it's the only real money and stuff. Hey, gold is bubbly. And it's back in the last part of the worst part is this last 3.5 years since COVID, okay, when they really, the last 5 years, gold has outperformed the stock market in the United States. It's bubbled more. So when Peter Schiff and other people say, oh, gold is the safe haven, gold is the anti-bubble, I'm like, how can something that bubbled more than stocks be the answer? It's part of the bubble. And that is something, probably the most important thing to understand. And this is a common term now. More people are calling this the everything bubble. The roaring 20s was an everything bubble. Real estate didn't bubble because nobody could get a damn loan back then. 50% down, and 5-year mortgage. So it's hard to speculate in real estate, and most people couldn't even qualify for a loan. They had to buy it out of their savings. So this time, real estate's bubbled way more than any time in history, while stocks have just done the same thing because rich people have always dominated stock holdings, top 10, 20%. That hasn't changed much. Real estate has never bubbled like this, never as globally and broadly. And real estate hits people much harder because of their mortgages and because
yeah.
it affects their life and everything. So people got to really look at their real estate. I am rushing to finish the kitchen in our house that I bought. I bought a house years ago when I told people not to because I got such a deal in Puerto Rico when I moved down here. But now I am rushing to get it finished so I can list it. Literally, I want to sell it by the end of this year.
Okay, Harry, real estate is a bubble, gold is a bubble, but what hard assets should people hold instead of those two?
There's really only one thing: the highest quality long-term bonds possible. And you know what? People always like, oh, the US is a drunken sailor and we're borrowing too much money. Yes, we are. But guess who's borrowing more than we are compared to GDP? Europe. Guess who's borrowing more than them? Japan and China. China's the biggest real estate bubble in the world. Compared to income, China's bubble makes the US look like a nothing burger. So China's going to get the biggest real estate bust. United States is the strongest in financial assets and financial assets ownership. Okay, that's going to be the second hardest hit. But China is going to get hit so hard they are never going to recover. And people in Japan, at a fifth of the income adjusted for purchasing power and all that good stuff, PPP and all, to the US, they have real estate that is twice as overvalued as the US, and they're going 75% of Chinese households' net worth is in real estate. It's only 38% in the US, okay? And Europe is probably less than that. So China is going to be the lead bubble burst here. China's going to go down, never see stock prices this high ever, never see real estate this price is high. We may never see them in other countries either, but China, not even a chance. And everybody thinks China is going to rule the world. China is a shrinking country following Japan just on about a 10-year lag, okay? Shrinking in population as far as the eye can see. They're going to go from 1.44 billion down to 0.78 billion, 780 million in the next 50 years, okay? While India does what? Goes up to from 1.4 billion to 1.7 billion, even higher. And India is the next China because they're doing everything China did on a 4-decade lag. They're going to go from 40% urban to 80% urban. And they are going to explode and be the biggest investment gains in all of history. And the US will be the best in the developed world only if you buy it after the crash and things get back to good valuations. But India and Southeast Asia are going to be where the next boom is, just like Japan and China and East Asia were the fastest boom in the last 4 decades.
Okay.
Imagine if you'd have bought China in 1982, Chinese stock market or Chinese real estate. I mean, the gains would have been incalculable.
Yeah. Final question. When it comes to the labor market and unemployment rates, what do you expect in 2026 for the US market?
I expect unemployment, it's not going to go to 25%, I don't think, like it did in 30 to 32, but I think it will certainly go. Here's my thing for everything. It's called 1.5x. The stock market crashed 57%, S&P is 1.5 times that gives you this, 88, 90%, okay? If unemployment was 11% last time, it's going to be maybe 16% this time. So that would be the worst since the Great Depression. And that would be just absolutely stultifying. And again, such a thing hits real estate the worst. And the only thing I tell people is, it, again, if you're going to hold something, hold that high debt one and hope that the banks do some moratorium on debt and say all banks have to write down mortgage debt by, let's say, 50% to get people. But if that happens, another reason to keep your if you keep your high equity house, you're not going to get a benefit if the banks are forced to write down mortgages with stimulus. The bank stimulus would go into helping banks. I mean, the government stimulus should go into helping banks write down mortgages, which gives consumers the biggest relief, okay? Back down to fair market value. So if that happens, you're only going to benefit from a high mortgage house, not an already paid one. So sell your high equity house. If you got to keep one house, keep your high mortgage house, but I would sell them both if
Okay.
it were me.
It makes sense. Harry, how can people reach out to you?
Very simple, harrydent.com. That's where you get on my free newsletter. hsdent.com, you want to learn more about it. But if you just want to get on our free newsletter, which means I'm going to send you an article every week and talk to you by rant, like, a 6 to 10 minute rant twice a month. And you can just listen to me as long as you want. And we just hope that 5% of people subscribe. That's what pays off for us. So get on our free newsletter at harrydent.com. You just get on there, push a button, you're on.
Are you active on social media as well?
Yeah. But you get everything, all my rants, particularly. That's the thing. Every other week, I do like I just did one today, actually, a 13-minute rant. So you're going to hear me video, and you're going to get an art every other week, and you're going to get an article from me, a 1-page article with a chart every week. So you will know what I'm thinking. And this is a time to listen to the contrarians. That's for damn sure. Most people will never admit, even Jeremy Grantham, who's as bearish as I am, he will only say a 50% drop. I'm telling people the truth. History says a bubble like this sees 80 to 95% drops. End of story. There are no 50% drops out of bubbles. So everybody else saying that is saying that just to be believable. I'm telling you the truth. This is going to be the biggest crash in our lifetimes, back 50 years and forward 50 years. Our kids will never even see this.
Yeah, Harry, thank you very much for this interview. I really enjoyed your predictions are not so beautiful, but
No.
they are your predictions, and I respect that. And really, thank you very much for joining me today.
Okay. Thank you, Lucian.